Today in this video, we're going to continue our series about how to get a mortgage in 2025 for my first-time home buyers. Today, we're going to talk about your debt to income ratio. Check it out. Hi, I'm Rhonda Burgess. I'm a real estate broker and mortgage underwriter here in the Nashville, Tennessee area, and my firm is Southern Living Realty Partners. All right. We're going to keep it going. Part three. If you missed part one, where we talked about your credit, if you missed part two, where we talked about your income, I'll link those two videos below. This is number 3 in the series of how to get a mortgage in 2025 for my first-time home buyers. We're going to talk about your debt to income ratio. I did credit first and income because you cannot come up with a true debt to income ratio if you don't know your credit score, your credit, what you owe, who you owe, how much you owe, or your income. And you need your income, correct income calculation to determine your debt to income ratio. Okay? Debt to income is exactly what it says. It means that your debts, when I talk about your debts are your minimum monthly payments on your debts. And let's define what a debt is. A debt is going to be installment loans, credit cards, student loans. That's normally all your debts. Okay? And it's the minimum monthly payment. It's whatever's on that statement. So if you have a $500 credit card, or you've got a $500 balance on a credit card, and it says the minimum monthly payment is $25, then $25 will be used as the debt for that particular income. If you've got installment loans, you got these you got these car notes. I'm not even going to touch it. I'm not going to touch it. You got these outrageous car notes, or you drive in your house every day. That payment, that's an installment loan. You got a signature loan from Main Financial. You got a signature loan from somebody. You got a furniture loan. Those are installment loans. The minimum payment has to be included when we're calculating your debt to income. On your installment loans, again, your car note, your personal loans, your signature loans, stuff like this. If you have less than 10 payments left, when we calculate it out, you can exclude that debt from your debt to income ratio. So let me say it again. Let's say your monthly payment on your installment loan is $300 a month. Okay. But you only have a balance of $1,500 left on that loan. Okay. So you take that $1,500 and you divide it by 300, right? So in that case, you would only have, sometimes my math ain't good. You'd only have 5 payments left. So since you're less than 10 payments left on that loan, then that payment, that $300 payment can be excluded from your debt to income. Okay. One thing that you cannot do is you can't say, okay, if your originator tells you are over the income limit, and you say, okay, well, I'll pay down this loan to where it's 10 or less. No, it already needs to be 10 or less when your credit is pulled right then and right there. I don't know of any lenders who will allow you to pay it down for it to be excluded. You understand what I'm saying? So that's what you need to know about your installment loans. Credit cards, your revolving credit. This is, again, just looking at the minimum payment. The minimum. Let's say you got an $18,000 credit card, debt that you're looking at. It's not counting the whole $18,000. Let's say you pay extra on it every month because you're trying to get it paid off. That's wonderful. But still, the only thing that's going to be counted is the minimum payment. So if the minimum payment on that $18,000 $1,000 credit card bill is $500, it's only going to count $500. Even though you've been paying $1,000, maybe you've been paying $750, you've been paying whatever. It's not what you've been paying. It's what the minimum requirement is. Okay. So that's how those debts are counted. Let's jump over to student loans. Student loans is going to be tricky in 25. I just don't know what's going on. The incoming administration has talked about they're going to get rid of the Department of Education. I don't know what that's going to do to student loans. I don't know if they're going to continue to be deferred. If the income-based repayment plans will still be in effect, or are they going to require the full payment? What's going on? I don't know. I don't know. This is November when I'm shooting this video, so I don't know what's going on with the student loans in the future. Just keep in touch with your student loan servicer if you have student loans. Also get familiar with your student loan servicer's website, because if you do have student loans and you're trying to buy a house in 2025, you're going to need to know how to get into your student loan servicer and get your letters showing how much your monthly payment is. Or if you're in a forbearance, how many months do you have left in the forbearance? If they are deferred, how many months are they deferred until those payments kick back in? When the payments kick back in, how much are the payments going to be? If you're on income-based repayment, if you're on which income-based repayment plan you're on, you're going to still need to be able to get into your servicer to get that information, to get those letters, period. Okay. Again, we don't know what's going on with them right now, but just proceed as normal for right now, as far as I'm concerned. If they are deferred until October 25, run with it until you hear otherwise. Okay. So just know that about your student loans. If you were one of the lucky ones, you got your student loans forgiven for whatever reason, hold on to that paperwork. Again, have your paperwork together. Have your paperwork together. That's another thing. You should have been checking your credit report. Video one. Anyway, you should have been checking your credit report to see if your student loans were forgiven. You need to make sure that they're reporting correctly. Okay? Because I found student loans are some of the weirdest reporting loans, because they move so much. This servicer to that servicer to this servicer to that servicer, from the government to the servicer, back to the government, the servicer, this, that, and the third. It may not be reporting correctly. If your loan gets moved to a different servicer, print out everything you can from one servicer, and then, because they're going to let you know it's going to go to the other one, and then make sure everything lines up. Make sure it makes sense. If it don't make sense, that's something you need to work on as far as your credit is concerned. Make sure you got that. But your debt to income, we look at your debt compared to your income. Okay. Most of your loans have a front end ratio. That's just talking about how much house can you buy. Every loan has the back end ratio, which is your debt to income ratio. So that means if we add up all of your debts, again, that's the minimum payment. Okay. On your credit cards, your installment loans, your student loans. And we compare that to your income. So let's say you get $4,000 a month in gross income. Again, income, that was video number 2. I'm talking about your gross, not your net. I'm talking about your gross, not your net. So let's say gross, you get $4,000 a month and all your debts add up to $1,000 a month. Okay. So we're going to divide your debts by your income. Okay. To get that ratio. Then we take that ratio and we calculate in your projected mortgage payment. So your mortgage payment plus all your debts cannot exceed the debt to income ratio for the loan that you're doing. Okay. Now, different loans have different debt to income ratios. And not only that, different lenders have different little guidelines. So in general, your FHA loan will have a 41% debt to income. It's going to have the 41% back end ratio. Again, that's the house payment, the projected house payment, and that is PITI. That's principal, interest, taxes, and insurance. That's the full payment, right? Plus all your debts. Your monthly payment on all those debts normally cannot exceed 41% of your total income. So in the case where you have $4,000 in income, all of that cannot exceed 41% of that $4,000 income. Period. That's it. On FHA, I've seen a back end on a FHA as high as 48%. You know why they were able to go that high? Because they had a high credit score. They had other compensating factors. Every loan program has compensating factors because remember, this is run through a computer. It's run through an algorithm. It's run through an underwriting program. Okay. So even though like on the FHA, it may say the back end is 41%. And let me just say that's just normally on just a standard FHA loan. If you're getting down payment or closing cost assistance, your back end may be even lower. Your back end may be a 36 or a 38%. You need to check that of which program. If you're getting assistance, know that in general, if you are getting down payment or closing cost assistance, you have a shorter back end ratio. You may not have 41%. They may only let you have 36 or 38% because you don't have that much skin in the game. So they don't want you to carry that much debt. That is why the debt to income is no hard and fast number. It can fluctuate, and it depending on if you're getting assistance, depending on your credit score. That's why you need a high credit score as high as possible, and other compensating factors. Let's go into the compensating factors. Compensating factors are time on job. Have you been on your job? Have you been job hopping? Was you here 3 months? Was you there 9 months? Or have you been this W-2 employee on your job 5 years or more? Same job, same everything. That's a compensating factor. Do you have reserves? Meaning, once we close this loan and you pay your closing costs and everything, you sign all the papers, you get your keys, yay, happy day. Are you going to have some money left in the bank? Or are you finna use your last dollar to get in this house? If you have savings where it is demonstrated you will have savings, whether that's your 401, your retirement, your money in your actual bank account. If you will have money left over, that's a compensating factor. So you may be the computer model may extend your debt to income ratio because you have money. You want to have as many compensating factors as you can, especially if you're going to be tight when it comes to affording this house. I'm not telling you to buy more than what you can afford. I'm not telling you to buy more than you're comfortable with. I'm just being realistic that prices are so high across the country that it may be just to get this house that you want that fits your needs. It may be pushing you in terms of your debt to income just to be able to afford this house. That's what I'm talking about. I'm not talking about splurging and going all out and trying to impress folk that don't like you anyway, that's going to talk about you anyway. But that's another, I've already done that video. I'm not going back. But anywho, what I'm talking about is the basic house that you need in that school district or whatever you want to buy a house. You may be stretched with your income just to get it. So what I'm saying is that's why you need these compensating factors, because sometimes you may need to stretch that your back end ratio, your debt to income ratio. Because see, again, if you making another $1,000 a month on your side gig, you doing hair, you baking cakes, you driving Uber, you doing Uber Eats or whatever, but we can't count that money because you ain't filed taxes on it. You hadn't been reporting it. So therefore you may need, for your back end ratio, that debt to income ratio, to stretch a little bit. You got the income, we just can't count it. You see what I'm saying? So that's why you want to have any compensating factors that you can have, because sometimes that DTI will need to be stretched over what these normal limits say per different guidelines and everything. And just know everyone has different ones, but it all comes down to what the computer, how the underwriting model views you as a risk. As a risk. Everybody's run through the underwriting models, period. And the underwriter and the desktop underwriter tells us what that back end ratio has to be. Now, then it comes down to, a lot of times your originator needs to be able to look at that and know how to tweak, like certain things. Like if you got a credit card, let's say you real tight or you over the limit, but this credit card of $1,500 with a $35 payment, you could pay that off and bring that DTI down. You see what I'm saying? Because we just took $35 out the payment. Or that car. Okay, and let's talk about one more thing on that debt to income. Your debt to income will include them things that you co-sign for other people for. It will include those other things that you co-sign for other people for. So if you co-sign for your sister's car and her payment is $445 a month, that $445 gonna show up on you. That $445 gonna show up on you. Yes, there are ways that you can, if you are just the co-signer, there are ways we can exclude that. Let me give you an example. You co-sign on your sister's car. It's your sister's car. She drive that car every day. She paid a note. She either give the money to you, or you gave her the login and she pay it every month, or some type of way she have it directly coming out her bank account and she pay that loan every month. There are ways we can exclude that. We would have to get proof that your sister has made those payments for the last 12 months. I want to see your sister's bank statements. Do you see how I'm telling you, when it's other people involved in this? Okay. It's other people involved in this. So you're going to have to make sure you have these conversations. You need to have a conversation with your sister. Look here, girl. Look here. Because I co-signed on that car loan of yours, I'm going to need 12 months of your bank statements showing that money came out of your account and paid that loan so that it can be excluded from my debt. Y'all need to have these conversations ahead of time. You need to have these conversations ahead of time. Number one, you shouldn't even be, co-signing for them, but I'm not in that. That ain't got nothing to do with me. Okay. So what I'm saying is, you need to make sure that what debts you can exclude. Again, a good loan originator, I'll put Matt's information in the video, in the description or whatever. But a good loan originator will be able to look at that. But you gonna need the history of her paying that, of it coming out of her account. Now, on the flip side, let's flip it around. She needed a car. Your sister needed a car and she couldn't get jack because her stuff is toe up from the flow up, right? Okay. So even with you co-signing, that wouldn't work. So you put that car in your name and she's really like the co-signer, okay? But it's her car. That's your debt. You're not going to be able to exclude that debt. It's not going to happen because that's your debt. As the bank, as the lenders, you the primary on that loan. So it's your car. I don't care who drive it. And you can show me all till the cows come home that how your sister pays that debt. That's your debt. It's going to count against you. This is why I'm telling you, you got to do so much homework ahead of time. Make sure your stuff is straight so that you don't get your feelings hurt. Because the worst thing you want to do is go out here, find a house. You all excited. You done put in a contract. They done accept your contract. You working on all this and all that. And your DTI is shot. Because you didn't do the homework ahead of time. So again, you need to know what your debt to income is. And the only way you'll know what your debt to income is if you've already looked at your credit and their credit, and you've already looked at your income and their income, so you can make sure that you got this correct. All right. Okay. Again, this was the video where we're talking about your debt to income limit. The best way to find out what your debt to income is sit down, calculate everything, add it up, and then so you can take a complete picture to your loan originator, and so they can put in a correct debts to give you what your debt to income ratio is, and that'll show you how much you can buy, because you may not be able to buy as much as you thought you could based on your debt to income limit. All right. Part 4 is going to be coming up, where we're going to be talking about the actual property that you're looking to buy in 2025. Thank you. And as always, have a blessed day.